All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Eric Dhall.
Hey,
It's 10 a.m. Pacific time here, May 9th. Eric, I don't know how much you're interested in this, but we did or it was determined who was going to fight for the Champions League title. It's going to be PSG versus Inter on May 31st. And then closer to my heart, the Spurs are going to play Manchester United on, I think, May 21st for the Europa League title. So battle of like the 15th and 16th place teams in the EPL table battling for a Champions League spot. It's pretty fun.
all the tears of the Barca fans are flowing, but it is what it is.
That's right. You can't, if you allow 7 goals, I think maybe you should take a look at your defense as opposed to whining about the refs. But let's get into the where are we for the week. Interesting week. It seems pretty quiet today. We're down on the week. S&P down about 60 basis points. Your big winner there is industrials up 75, tech up 20. These are basis points, and consumer discretionary. It's flat, slightly up is the number 3 winner there. So a pretty mixed bag there across the board. Looks like your big loser was healthcare down 3.5% and real estate down 1% or so. So really looking at it quiet. Still up on a month-to-date basis. So you can just see how well those first 2 days in May performed, just to give us that upward movement on the month. Still down, S&P down 3.5% on a year-to-date basis. Looks like consumer discretionary, the big loser, year-to-date down almost 10, tech down 6.5, and energy down 3 and change. So, really looking at it though, it seems like we're taking another breather here. A lot of trade talk going on. We had the trade deal yesterday that people felt was kind of moving in the right direction at least. But really
trade
kind of a
framework, man. It was a trade framework.
That's right. It was a framework for the I think the U.S. is like 11th largest trade partner. So maybe it's a framework that we can expand upon for other maybe more important trade partners there. But that was kind of the wrapped up for the equity side of things, or I guess not the wrap up. Let's go. Russell 1000 was down 50 basis points. Russell 2000 down 15. So small mid caps did a little bit better there. Growth down 75 basis points. Value also down 13. So value outperforming growth a little bit. You have the NASDAQ down 50 basis points. And surprisingly, to me at least, looking at it, with S&P market cap weighted down 60 basis points, the equal weight actually up 19. So equal weight putting in a good week there. If we kind of switch over to the bond side of things, we had rates up across the board. The 10-year was up 6 basis points. We're at 437 as of time of recording. The 2-year up 4 basis points. So a pretty big move on the 2-year. Most of that was yesterday. You're at 387 there on the 2-year as of time of recording here. That means the ag was down 10 basis points, mostly on the government side. The government sleeve was down 20. Agency mortgages eking out a slightly positive return, about 5 basis points or so positive, and the investment grade corporate bonds down 7 basis points. So, not much volatility there, not much dispersion between the different sectors of the ag on a week to date basis. But the more riskier side of things did a little bit better. High yield up 1/4 point, bank loans up 0.5 point, and EM right in the middle up a 1/3 of a point, let's call it. So all in all, your riskier side did a little bit better on the week, but really not much vol. Kind of looking at it on a day-to-day basis. Only yesterday was on Thursday, we had the 10-year up 11 basis points. Everything else was within 5 basis points move. So really only one day of market movement, or market vol anyway, from the bond market. And finally, to wrap it up, commodities up 1.5%. Everything positive except for ags. Ags were down 1.25. You had energy up 3.6%, kind of surprisingly given all the news out there. And I guess you did see a lot of vol there from oil. It did seem like one day, oil was down $2 and then up $2 and then down $2. And we're looking at it's almost $61 a barrel for WTI crude today, or as of time of recording. We're down at like a 58 handle earlier in the week. So a pretty big move there. Maybe the after effects of the OPEC Plus meeting got a little bit overblown, and people were, got a little bit too bearish on oil. And also maybe we have a little bit more of with the trade framework coming out, less probability of a recession, and the demand side of oil maybe not being as bad as people were expecting. Industrial metals up 50 basis points, mostly gold there, up 3%. And finally, let's look at, and all industrial metals up 50 basis points, and precious metals are up 3%. Yeah. Gold at 33.43 there. So let's see how that works. Oh, and Jason just sent me a reminder that we did see Bitcoin. Sam Lau, you're on this listening here live, and your favorite asset crossed over 100,000 again. I think first time since February. So we're at 102,526. Sam, if you didn't know what it was as of time of recording, but that was kind of it for the market. Kind of a quiet week, quiet on the macro front, even though we did have the Fed meeting this week. So Eric, why don't you hit us up on a quick wrap up of the 2 or 3 data points that we did get from the macro perspective?
Yeah, definitely. I mean, very light macro week, so we're just going to get to it. On Monday, we had the ISM services drop. That was the April print. Came in at 51.6, which was much better than the estimate of 50.2. And when you dig in a little bit, the details, it was improvement pretty much across the board. I guess the one downside was prices paid were higher. Services prices were at 65.1, and that was the highest print since January 2023. So that's kind of one thing to keep an eye on, maybe if you're an inflation hawk. Tuesday, May 6th, we got the trade balance for March, and it wasn't a shocker that was massively negative, minus $140 billion, minus 140 billion and a half, actually. So it was a big negative print, and it makes sense given all of the trade fears and people trying to get goods in before the tariff wall went up. On Wednesday, we had the FOMC rate decision, as Mr. Mayberry mentioned, and big shocker, no changes. Came in exactly on the previous, and we're going to discuss that in the topic of the week. But my impression was Jay Powell was very tranquil and calm in that meeting, and he just wasn't flustered, and he just seemed very content to just sit there and do nothing and watch and observe. Thursday, we had unit labor costs came in at 5.7%. The estimate was 5.1. I don't know if I dig too much into that, but something to keep on the radar again. Maybe that's the services kind of prices index, there. I don't know. We have to keep an eye on it. We also got the initial jobless claims for the week of May 3rd, and they came in at 228,000. Very similar to the estimate, a little lower than the previous, which had jumped up, which got bears excited a little bit, but kind of back into like the nothing to see here range. The continuing claims dropped at 1,879,000, and that was very similar to the estimate and a little lower than the prior, which was over 1.9 million. So that wraps it up for the week. It was a light week. Other than that Powell presser, I think most of the moves in the market have been driven by that trade framework that Mr. Mayberry mentioned.
Yeah, I mean, if let's go back to the Fed here, and the big question kind of going into the Fed, everyone, the Fed left rates unchanged. That was expected. They didn't change their balance sheet. That was expected. The question was like, how's the Fed, the FOMC as a committee thinking about the tariffs? And so in the press conference, I pulled a few quotes, and we'll kind of get to it. And most of it's just they don't know what's going to happen. And Jay Powell did say, quote, "The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain." End quote there. And so you can kind of see, they don't know what's going to happen. The next quote is, "I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that." And that quote. So, it's just like they just don't know. Well, obviously, you don't know where the trade policies are going to settle out. What their effect is going to be on the economy, and so they, as you said, Eric, they're just kind of biding their time, waiting to see. And I think in this statement, or one of the other quotes is he kind of referred to the statement. He said, quote, "We have a situation where the risk to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have," end quote. And so at least the Fed is aware that, the tariffs could affect inflation to the upside, employment to the upside, or the upside with higher unemployment. And really that puts the Fed, kind of between a rock and a hard place where they don't know the effect of the tariff policy. They don't know what the tariff policy is going to be, but they know that potentially it's bad for both of their mandates. And so I guess the question is going to be, and Jay kind of talked about it a little bit, is, if something gets out of whack, which one are they going to focus on, inflation or the labor market? And he did say that it's, he had said in the past that there's whichever one's further away from their goal, that's the one they're going to focus on. But he also brought in some sort of time element this meeting, which is like which one's going to take longer to fix, and then that will be the one that they will kind of focus on. And so to me, that kind of leans more towards they're going to be focusing more on inflation. If everything's kind of equally far from their goal, they're going to focus a little bit more on inflation than on the labor market, because I think that the labor market could snap back pretty quickly. But as we saw, inflation takes a lot of time to get back down towards where they maybe want it to be.
I tend to agree with you. They're definitely afraid of the stagflation boogeyman, and they don't want a repeat of the 70s. And, Jay Powell's already experienced a bout of inflation, and he doesn't want to be the Fed chairman to let the inflation cat out of the bag. So I'm aligned with your thinking on this matter, Mr. Mayberry. Like, they'll probably be more concerned with, structurally much higher inflation. But you have to wait and see.
Yeah, and he's done in next May, and they tried to ask him questions about like what his future is going to hold, and he shut those questions down, and then they tried to ask him again. And so I guess that's the typical of these types of press conferences where there's only one focus, and so all the reporters are trying to ask the questions in a different way to try to get Jay to slip up and maybe give them a little bit more information than he would want to give otherwise. But he was pretty flat out, adamant about not really talking about the future and not talking about the fiscal side and the president, and stuck to his guns, at least on that one. But you saw if we kind of go to where the interest rate probabilities are shaking out right now, looks like June we have a 17% chance of a cut, so that's down pretty significantly. We were above 50% not too long ago in a June cut. We're up to 70 or 69% in July. And we don't go till September till we get above a 100% chance of a cut. Still pricing in 2.6 cuts for the year. There's only 5 more meetings, so to get 3 cuts or 2 cuts, it's going to be pretty interesting to see how that goes for the rest of the year. We're still pricing out 4 cuts in the next 12 months or so. So that first cut just keeps getting pushed out. It doesn't really seem like the Fed is in any hurry to cut, and so it remains to be seen how that goes from here, but it's going to be, data dependent and tariff dependent.
It's all about the tariffs and the big, beautiful bill these days, I think, and we're just going to have to navigate the storm.
That's right. Well, Eric, it's inflation week next week. You want to highlight some whatever we got going on and the things to keep an eye on for next week?
Yeah, for sure. On the radar screens of our listeners, I think, the first thing to come out is the NFIB small business optimism, and the expectation is for it to be 94.7. I wouldn't read too much into that because it's a soft data point, but, we'll let you know what it prints at. The CPI is the big thing coming out on Tuesday. We get CPI month over month for April. The estimate's 0.3, and so that's the prior was minus 0.1. So definitely something to keep an eye on. And the CPI ex food and energy is predicted to be 0.3 as well, and that's obviously going to be higher than the prior 0.1. But looking at base effects, looking at roll off, the expectation for year over year CPI's headline is going to be 2.4, and for core 2.8. So those are kind of in the area of the Fed's comfort. So keep an eye on that, because if it's much outside that would definitely be an area that could spook the markets. Thursday we get retail sales, the advanced month over month print for April. The estimate is for it to be flat at 0%. So that's definitely a kind of a, sitting on your hands prediction, but we'll see what the actual print is. The control groups predicted to be positive 0.2. And on Thursday, we also get PPI. The final demand is predicted to be positive 0.2% month over month. And those are inputs to PCE. So a lot of market tacticians are going to be looking at that to try and see, okay, with the CPI and the PPI, you can kind of start to get a better sense of where the PCE is going to be. And that if that comes to pass, the the PPI final demand year over year would be 2.5%. But, those are just speculations. We'll have to wait and see the actual print. Industrial production also drops Thursday, and that's predicted to be at positive 0.2%. So we'll see. And Friday, we get housing starts, building permits, the import price index, which, will be an interesting one to see for the month of April, and the University of Michigan sentiment survey. So those are the kind of things to keep an eye on for next week.
If we get to, we did figure out some tech issues on our emails, and so we have a backlog of questions here. We got a question from Rich asking, are we close to a Liz Truss moment? We got a question from Jay asking about monetizing the debt. And we got another question from Rich that we'll cover next week asking about yield curve control. And, those of you that watched Jeffrey Gundlach on CNBC post-Fed, he did mention on TV, so that's something we'll get to. And I think Mark is back, so we'll make him dive into yield curve control here next week, next Friday on the Minutes podcast. But with that, I think that wraps it up for this week.
Yeah, thanks to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with your questions, comments, or suggestions.
Yeah, now that we figured it out, we'll be sure to get some more topics of the week going here. Don't forget, you can check out our YouTube channels at youtube.com/doubleline capital. We have Jeffrey Gundlach's CNBC interview up. We have Jeff Sherman's Yahoo interview up, both in the past couple days there. So those are obviously very highly recommended watches. And with that, I hope everyone has a great weekend.
Yeah, have a good weekend, all.